Robert Kiyosaki has written numerous books about the benefits of investing in real estate. This is how the multimillionaire made a large part of his income. But what if you want to invest in this sector but don't have the money? Welcome. In today's video, we are going to talk to you in detail about the income-generating secrets that Kiyosaki uses with regard to real estate, and we are going to tell you how this business model is applied. Stay with us and find out what the key was to his success. Let's get started. Using other people's money is exactly what it sounds like. Using other people's capital and money to invest and control more and larger assets. The benefits are many, but one big advantage is that you can increase your cash flow much faster, more reliably, and more effectively than if you would use your own money and capital. Although it may seem counterintuitive to use money that is not yours, this is exactly how you will find investment success. Other people's money gives you, the investor, the power of leverage. As an investor with little capital or investment money, you can use the power of greater capital to make investments that can yield great returns. Think of a child's seesaw on a playground. If you're a small child at one end and an older, bigger child on the other end, you'll have a hard time lifting the other child off the ground. But if you move the smaller child closer to the center, suddenly the smaller child's strength increases and you can lift the larger weight off the ground. Suppose an investor has $1,000. He can invest that $1,000 in the stock market and control $10,000 of wealth. This is an unleveraged investment. But if he uses the $1,000 as a 10% down payment on a property and uses mortgage money for the property, he now controls an asset of $1,000. This property or asset can generate much more cash flow than a $10,000 asset. Other people's money allowed this investor to invest in a larger asset. To do these deals, Kiyosaki talks about good loans and bad loans. These are so called because in the first case, the person who applied for the loan does not pay it back, while in the second case, he does pay it back if he buys a physical property, such as rental properties or home flipping. You can make money in two different ways: rental income or rent and appreciation of the property. Unlike other investments, real estate is dramatically affected by its location. Factors such as employment rates, the local economy, crime rates, transportation, the quality of schools, municipal services, and property taxes can drive real estate prices up or down. This is where good debt comes in, because we get a house because of a bank loan and we are not the ones paying for it. Since the property is rented out, someone else is paying for it, leaving our money intact. This is Robert Kiyosaki's real estate investment policy. So how can we maximize this strategy by knowing what is around us? It is that the properties that are close to ours also have potential factors. If our property is in an area near an educational institution, it will be attractive to students or entire families who want the convenience of a nearby institute. The cash flow has been positive since the first year. We bring in money for rent and pay a portion of the loan to the bank, which leaves us with a positive cash flow per year from the first year, which will grow as we pay off the debt to the bank. And that goes on our balance sheet passively because we are not really working for it. Robert Kiyosaki says that it is not necessary for the price of the house to go up for the investor to make money. It does not matter if it goes up, down, or stays the same, because the important thing is that the cash flow is positive. In addition to this cash flow, we have a property that can continue to be a source of income for us. Investing in a house does not prevent us from investing in other assets if they put money in our pocket and do not generate additional expenses. As for the first home, this concept may be questionable because the alternative of not buying may be even more expensive. But again, cultural and societal issues add up. For a person who needs to move around the world, buying a home is clearly a commitment. And if we think about it a little more, we will see that buying a second home can undoubtedly be a big commitment. Beyond the discussion of whether a house is an asset or a liability, it is important to start investing as early as possible in assets that put money in our pockets, whether it is stock dividends, appreciation, interest, business profits, or real estate income. We can choose to invest in real estate by taking out a mortgage, either partially or fully, to rent it out. This works as long as the expected income, in this case the return on investment, the rents we generate, is significantly higher than the cost of the liability, in this case the interest rate we pay on the mortgage. This is what central banks are doing today, reducing the cost of money to zero or negative interest rates in order to stimulate investment of all kinds. Let's imagine that we were able to buy and rent a house that earns us 5% on the investment, while the bank charges us 1.5% interest on the mortgage. In this case, we would have a passive asset that earns us 3.5%. Having information and acquiring this skill can help us achieve our financial independence faster or more comfortably. From all this, it is clear that a family economy is not very different from a company. A family should equip itself as soon as possible with assets that generate returns. Everyone needs to invest at their own pace, with clear financial goals and an understanding of their risk profile. If we only save and do not invest, we will not add assets to our balance sheet, which will limit our ability to generate returns on our savings. Well, we have reached the end. If you enjoyed this video, don't forget to subscribe to the channel and turn on notifications so you don't miss any new videos. And remember, Kiyosaki is in every investment you make.